Welcome and thank you for joining us for the latest episode of Venture Voices, our deep dive into the VC ecosystem and the exciting world of startups and scale-ups. Today, I'm delighted to be joined by Jon from Mountside Ventures. Jon, welcome.
Thank you. Thanks for having me.
Delighted to have you here and looking forward to peppering you with lots of questions. Hope you don't mind.
No, looking forward to it.
And to start us off, before we dive into those, maybe provide the listeners an overview of your background.
Yeah, Jon, I'm one of the co-founders / partners at Mountside Ventures. In terms of personal background and biz background, grew up in Croydon. I actually studied pure mathematics at university.
Good fun.
Yeah, real good fun. To add to that excitement, I then joined Intel after university.
Oh, right,
The used to be very cool tech company. Learned a lot there, but I think during that time was when they declined to acquire NVIDIA for a very small amount of money. So I thought, not because of that, but I thought I wanted to get more of the London finance experience. I moved to PwC, did the grad scheme there, became a chartered accountant, and then moved into the advisory practice where I there met my two co-founders, and we started the early stage fundraising department, which we ran for a number of years before realizing what we wanted to do in the startup ecosystem wasn't really aligned with the strategy of the PwC as a whole. So we decided to leave and set up separately and be a startup for startups.
Yeah, very exciting. And actually the PwC Raise program did obviously have a great interface into startups to kind of get you in there initially, didn't it?
Yeah, it was definitely really good to learn all the ropes on someone else's money. If I was going to be honest, and the credibility you get from the email address and the logo definitely helped open some doors that maybe would have been harder to do from scratch.
In establishing Mountside Ventures, what was the gap in the ecosystem you're looking to plug?
Really, when we were looking at it, what we saw was at the time, and to some extent still now, there's a real lack of qualified professional advice at the very early stage. By very early stage, I'm talking about Series A. I'm not talking about pre-seed or seed. So it's kind of that inflection point where your raise becomes less about founder and market and more about data, financials, running a process, and finding all the key pieces of a value proposition that you never really had to think about when raising your pre-seed and seed rounds. And so we thought, let's start Series A, because Series A is the hardest round a founder will go through. There's the largest percentage drop-off between seed and Series A. So we thought,
okay,
yeah. So pre-seed to seed is pretty high. Seed to Series A is incredibly small. And then Series A to Series B is typically an easier journey, but depending on how you classify like what a Series B is. And so we thought, let's tackle the Series A ecosystem and tackle Series A raises. And then since we started on that journey, we've closed probably around 55 to 60 institutional deals at that stage. And then naturally, as we were we were building brand, we built a lot of confidence and trust with both the founder communities and the investors. The investors knowing that because of our model, we work with a very small number of companies at a time. And so we kind of put our name and our brand behind the companies that we work with. And then naturally, investors started referring us companies that they maybe did the seed A round to help them with their next round. And what I'm trying to drive in Mountside, and what we've done very successfully over the last 12 months, is move from the Series A to the Series B market, where I guess if Series A is half art, half science, I'd say when you get to Series B, it becomes a quarter art and 3/4 science. And so that really kind of naturally fits our skill set. And so that's what I've been working on the last 12 months.
That's super interesting. I've got loads of questions about that particularly, but I'll try and stay on agenda as well. What are you seeing in 2025 are the main things that founders or CFOs are getting wrong with a fundraise, or what are the challenges, and how are you helping founders course correct?
The main challenge founders are having is that the VC ecosystem in itself is continuing to be sheepish on deployment of capital. We also, probably a side note to mention here, we also run the Emerging VC program where we, in the same way we do with founders, we support high potential GPs in accelerating their fundraisers from our network of limited partners and family offices. And through that, we've seen that, I think we got something like, Jonathan will be able to correct me here, something like 400 applications from GPs who wanted to raise funds but were struggling to. And we filtered that down to the 20 best GPs to come onto our program. And so if there's that number of funds struggling to fundraise in the market, that unfortunately means that there's a smaller amount of capital to deploy into companies, and less choice for founders. You're also seeing, I guess, a consolidation of LP capital in a very small number of funds, which there's mixed opinions about in the market, but my view is that more choice is better. Smaller funds, a larger number of smaller funds is better to serve the startup ecosystem. It makes funds more competitive on terms. It makes them more timely on their processes.
More diverse backgrounds, maybe more variety of ideas of where they'd like to invest.
Yes, yeah, spot on. And so I'd say that's probably one of the main challenges. The second big challenge is a lack of financial support. You can raise Series A essentially without a CFO, with someone who works on your finances. We work with lots of companies that outsource their finance department going into a Series A. But then post-Series A, you really need to bring on a CFO to help drive all the metric tracking and data analysis that you need to raise a competitive Series B round. A lot of our growth stage clients, we're still retrospectively going back and helping them prepare this from the data they're tracking, but they haven't been doing anything with to date. And so getting really on top of things like your cohort analysis, your GRR, your NRR, gross revenue retention and net revenue retention, and how your unit economics will scale over time, and also what is your detailed use of funds interlinking with your product roadmap, and specifically how will you not create your own AI, but how are you going to use AI to make your business a lot more efficient and a lot more competitive and drive a USP.
And I can't avoid not digging into the topic, but Series A, half art, half science. Series B, quarter art, 3/4 science. Obviously that leans to data being key and lots of things, but maybe just in layman terms, how do you describe that difference?
I'd say with Series A, you're essentially extrapolating from a very small number of proof points. We've worked with lots of like B2B SaaS companies who have a handful of clients and raise Series A off them. To get to a million ARR, if you're in B2B SaaS and you're selling to enterprises, you only really need like 5 to 10 clients sometimes.
Yeah, so true.
And some of those are on different contract terms, different contract lengths, different ACVs for the same value that they're getting. And so you're basically trying to extrapolate from a very number of small proof points across a market size that, again, isn't fully defined. And the question is, at the Series A, is like, what is my ICP? I've sold to this type of insurance company, I've sold to this type of bank, I've sold to this type of asset manager, just if we're talking about, I don't know, financial B2B SaaS as an example. But the proposition is that, okay, we sold to all these different type of markets. However, this is the market we want to put the funding in because we think that's the ICP. We think that's the best one from the very small number of data points that we have. When you get to Series B, you have to have your ICP super defined to kind of a very granular detail. You need to go into a Series B round showing that you've done all your testing, and now your market is very clearly defined, and now the go-to-market is purely just repeating the metrics that you already have, rather than taking what a Series A investor takes, which is a lot of product risk and market risk. A Series B investor wants to be taking go-to-market risk.
And I guess if we dig into the Series B specific, where data becomes more important, and we think about NRR, and retention, but also upsell. How important is that as one of the metrics? Is it in the top three? Do you have like a top 3 or 4 metrics for a Series B that you really want to demonstrate?
Yeah. I would say when I first started working in venture, NRR and GRR was a thing people would read in books but never really talk about or due diligence on. It's now become like probably the key value point and one of the key fields that we use for when we decide to take on a client or not. We have essentially our IC guardrails. If a company is below 80% GRR or below 100% NRR, we have to dig into that and investigate and ask them questions about it.
Because you're worried about how sticky the product is?
Exactly. How defensible they are in the market, how sticky it is, and also pricing pressure as well. We investigate the correlation between if a company would raise their prices, how would that affect their NRR and GRR? And we've worked with some amazing CFOs who've really been able to show that they've raised prices and then the price increase that they've been able to achieve across their client base outweighs the churn that they've received from implementing the price increase. And I'd say that's very kind of like gold standard when you're speaking to a CFO and they're able to kind of demonstrate that really well through analytics and data.
Other than GRR, NRR, what other things do you really like, either at Series A or Series B?
Sales efficiency, we look at quite a lot, especially for going into a Series B round. One of the deals I worked on, this was heavily diligenced by the investor and I was very impressed by it. But the ramp up time to quota across the sales head cohort, because by then they had about 8 sales heads going to their Series B. So the ramp up time to quota, what is the quota and what is the ratio of the ARR generated per average sales head versus the total comp? And if you're able to see that that's kind of 2.5, 3 to 1 in terms of not the CRO and not the founder leading the sales, that's important to cut out of that analysis. But if you're able to see that a sales head is over a 6 to 12 month period, bringing in a multiple of their compensation, then you start being able to really show the reduction in go-to-market risk that we have 8 sales heads. This is their sales efficiency. If we then sub in another 10 sales heads and they perform in the same way, this is where we can get to in the 2-year capital deployment period.
Yeah, super interesting. I would assume for a seed business approaching a Series A, the vast majority is dealing with a founder, not a CFO. They may have a fractional CFO, but many won't. How do you compare founder backgrounds and personalities and the effect it has on either the success of a fundraise or their ability to lead it themselves?
This is an interesting topic because my 2 co-founders have very different opinions to me on this.
Right, okay.
And so we always come together and
have a fight
and argue
nice.
this. My dream founder to work with at the Series A stage is direct, to the point, no fluff, give it to me as it is, and is able to flex their work schedule to the needs of raising capital. My other half hates this, but I really like it when a founder, something comes to their mind at 11 p.m. and calls me on WhatsApp to have a chat through.
I don't understand why your partner hates that.
And so, that ability to address a problem up front and work together to fix that problem as it arises, rather than waiting till a set check-in meeting or waiting till they've sorted something else out. I really value that in a founder. It's very important for us, it's very important to be collaborative as the advisor to the company. And so I like to be an extension of the team. I like to be able to join the management meetings and have a discussion about what we're seeing in the market and how that interacts with what they're strategy formation should be, because fundamentally they're intrinsically linked between the two. And so, yeah, being very collaborative with the team. And then the last one that I really value is the founder deferring to members of their team, in terms of, if you're in a meeting with the head of tech or the head of product and the founder, and you ask a question about the product and the tech, if the founder jumps in and answers that straight away, it's kind of like, what's the other person doing? As in, you should show that you're the captain of the ship, but you should not try and be the captain of every department as well. You want to be able to show that you can hire people that you trust and who can look after their own house.
Yeah, I had this discussion on the last episode around the ability of hiring A players as functional leads and then having that trust. And actually you can feel a release of pressure from a founder when they've hired some amazing A players in, finance, product, tech, marketing. And actually they are proactive and at the forefront of advancing the company, and they want to lead those conversations with you, for instance. And a lot of what you've communicated here is around a maturity of a founder to not have an ego and be very passionate and very driven, but it's not about them, it's about the company and the growth of the company and the right thing for the business. And a collaborative, communicative individual that understands that the key milestone for the business right now is the fundraise and maybe one other thing, because the fundraise does take a lot of time and it needs to be a main, they need to feed into it a significant amount.
And takes longer now than it used to.
How long do you think it's typically taking?
Our typical Series A timeline has extended from about 3 months to 4.5 months.
Okay.
And our typical Series B timeline is around 6 months.
And what would that have been 4 years ago, 5 years ago?
When we first started the company, we closed our first institutional deal that we advised on in 7 weeks from start to finish. So just anecdotally, that was
Is that
5 years
post-COVID?
That was
just
late 2020.
Okay, yeah. So that boom period, late 2020, all the way through to early 22 was maybe a month less, 2 months less for the Series A and Series B raise.
I would say so, maybe even more with some deals. Wow. I'd say it definitely spiked up. I would say it's probably stabilized now. I'd say one of the main driving factors is many investors who, after the term sheet, as everyone knows, the term sheet is the midpoint check-in of the journey and not the final step. Many investors who previously had 30-day DD periods post-term sheet to close have moved that to 60 days.
Right.
And so that's in the term sheet. You're signing up for 60 days till close. And obviously that allows investors to do more pipeline diligence, to see if the pipeline is as strong as has been presented. And hot tip, it never is. But if you're signing a term sheet and you've said a key client will close in the next 2 months, investors, we're often seeing, will wait for that to happen before closing the deal. And so we've had some pipeline slippage in clients where that's been kind of a condition of close, and all the work's done, everyone's pens down, just waiting for one of the pipeline clients to come through to fruition and contract signing before the money's transferred.
Yeah, the delay of the actual signing the deal enables you to have more data points of what the company's done in the next 30, 60 days in terms of new customers, measuring, maybe seeing some of their management reports in terms of how they manage finance, how they manage the business. That's super interesting. Is there a number of term sheets that's healthy to have at that midway point? And you may not have this number, but is there a percentage for Series A rounds of, if you've got 10 term sheets or 5 term sheets, you're likely to get 3?
We optimize our process for 3 term sheets.
Okay.
So everyone talks about, like, how do you negotiate a term sheet and what terms should you push on and pull back on, and we've written a lot of reports and content exactly on this, but ultimately where I've seen material differences between initial term sheet and final term sheet is always when there are multiple investors at the same stage in the process wanting to do the deal. When a term sheet is issued from an investor, they've essentially put their name to it internally, and so they want to win the deal. And they can often look not that great if they then don't win the deal. And so an example around I worked on last year, the first term sheet the company got was at like 35 pre, and then they got another one at 55 pre, and then very finally they got one at 60 pre, right at the end. But the one at 55 pre for the founders, the difference of 5 wasn't enough for them to stop that process because they've built the relationship. And so from an investor point of view, there is a lot of merit into doing especially when a company is working with an advisor like us, putting in your final or your what's on the upper range of your best offer first. Otherwise, it can affect your relationship with the founder, and it can qualify you out of the process.
So true.
So even in this example, even though the investor who came in last had the best terms, the fact that they came in last and weren't materially higher than the one who came in much earlier and had done a lot more work in the interim was a big value point for the founders who
they believed in them first. They got what they're trying to do with the vision for the company, what problem they're trying to solve. It also demonstrates that they, obviously the belief piece, but also it's demonstrating that they want to be a partner and collaborative straight off the bat.
Yeah, exactly. And it also reduces completion risk. If someone has put in a lot more work than someone else who's coming at a higher valuation, if it's a higher valuation, they will have more expectations of company growth, and so it de-risks the completion risk. And completion risk post signing the term sheet is something that should definitely be thought about more.
It's really interesting. Most of our work is supporting VC-backed businesses, but quite often we'll support a bootstrap business as they look for a partial PE exit or full PE exit, or a early mid-market PE-backed business with their growth journey. And the ones that we tend to work with or get most enjoyment with is those partnership-led investors, the ones that are in the lower mid-market PE space that actually really want to help them, like a lot of VCs do as well. And it just makes that whole, it's a tough job being a founder. It's a tough job being a CFO in a startup. But having an investor that's partnership led, that you have as a sounding board, is just so much more beneficial to them.
Agreed. For certain profiles of founders, I'd say there are definitely some very good founders we've worked with who want an advisor but not a partner, if that makes sense. They want someone to be at the board and to give them advice, but they don't want someone to be in the day-to-day.
Are more of those second or third time founders, would you say? Or what sort of backgrounds would they come from?
I'd say we have, I didn't think this would be the case when we started the business, but I think we've developed a bit of a niche with very successful execs at corporates who have found an issue from the boards they've been on, or the problems that they've been solving on like very large enterprise level, and have created a B2B SaaS solution as their kind of their thing that they're doing in their 40s, not their 20s or 30s, to fix exactly the problems that they would see from their exec career. Those type of founders, I'd say, are the ones who kind of like, let me get on with it and do it, and you'll have a board seat, you'll join the board, and you'll advise me, but don't come into the office.
That's interesting. And how do you turn a founder's rough model into an investment ready, glossy story?
If I'm going to be really honest on this, we used to turn clients' models into fundraising models. We don't do that really anymore. We throw their model in the bin and we start again. We even when the model looks like 70-80%, we found that the time saving to go to market is never outweighs the time lost when you're in the market, because we carry the backpack on a lot of the all of the financials questions. So when a company we work with have met an investor and they've sold the dream, and they built a really good rapport and relationship from those initial one or two calls, and then they get the long list of 20 DD questions. We handle most of that ourselves, and so rebuilding the companies, we still use their documentation as a reference point, and we use all the information that they've been tracking, but we, across all deals we work on now, we rebuild the model in our own tried and tested processes and templates, which I've developed kind of from scratch.
And Series A raise has been completed. You've helped them. They've raised 10, 15 million. What does good look like in your perspective the next 6 months after that? What should a founder be really considering?
I think a lot of founders that I've seen try and spend money too quickly. Ultimately, if the financial model says that you need 10 engineers in the first 6 months, but you get to 6, from an investor perspective, that's fine. Pretty much always that's fine. It's better to find the right talent than the talent that comes in the time frame that you have. So spending money too quickly on typically tech talent and marketing budgets, deploying large amounts of capital into marketing budgets when you still have a lot of product development to do, I've seen as a bit of a not a mistake, because it's important to test your marketing, and in the same way that you're testing your product to develop your kind of lookalike audiences and develop. I'm talking about marketing, but same thing with sales. It's important to test, but not rushing key hires and not overspending on advertising campaigns too early before you've kind of righted the ship. I'd see that as definitely as an error that I've seen companies burn a lot of cash without getting the return needed, which then puts you into the bridge funding territory in 12 to 18 months when you might have hit 3 million ARR, not 5 million ARR. And going from 1 to 3 is great, but if you burn 4, 5 million, 6 million to do that, it becomes below the capital efficiency thresholds. And especially with things like no-code coding tools coming out, the capital efficiency benchmarks for later stage VCs have definitely moved. The expectation is that you can do your product development with less heads, maybe higher salaries, but less heads than maybe a few years ago.
It's interesting. We're doing a lot with AI and automation in finance functions at the moment. We've been running a kind of a monthly CFO masterclass on tech into finance functions, and it's likely in 2, 3, 4, 5 years' time, finance teams are going to be super lean. There isn't an AI solution that's solving everything at the moment. There's use case methodology for automation, but having an expert in the team that's interested in tech, interested in how tech can improve a finance function, and be that subject matter lead and proactive around implementing it to make it more efficient from a cost and headcount perspective is so important. And I think in a lot of startups that are doing really well at the moment, they're doubling down on really good talent, A players, and less of a team below, because those A players are ambitious for their career, ambitious for the company, and actually like the breadth and the ability to make a difference. I don't know if you're seeing lower headcount growth in some of the businesses post-raise than you were 2-3 years ago.
Yeah, I've definitely seen a shift from to less middle management and less lower compensated larger teams to definitely a kind of a smaller headcount, much higher salary and smaller team approach. And that's definitely well received by the VC market if you're showing that in terms of use of funds and how you're going to build your team going forward.
Has becoming a founder in the last 5-6 years, or 4 or 5 years, changed the way that you partner with founders?
I'd say for me specifically, I can't speak for my co-founders, and we do all make our decisions together. I've always wanted to be an entrepreneur. The reason I did the grad scheme at PwC is just because I didn't know what I wanted to do as an entrepreneur, and that's I'll get a qualification and I'll learn more about the industry. The reason I met my co-founder, Jonathan, is I pitched him my idea to start a fintech many years ago.
No way.
And he was the startup guy internally. So I pitched him. I was like, I want to work with you for a little bit, and then ultimately I want to leave and start my own fintech. When I was younger, I spent a lot of time with my granddad. My granddad was a refugee during World War II.
Oh, wow.
He came to the UK with nothing and then built his own business. It was in wood veneering, which isn't really a tech industry.
It's niche.
But kind of like dashboards of cars.
Oh, cool.
where he was helping companies bring the cost down of, instead of using solid wood, you use cheap wood and then veneer very expensive wood around it.
Yeah.
It wasn't a big business. It was very much an SME business. It was based in London. It was manufacturing. But I always super admired like what he did, like building it from nothing. And without any contacts and without any family, pretty much being in London, coming to London on his own on a boat to escape the war. And so since a very young age, I've always wanted to be an entrepreneur. And I guess most of my academic decisions along the way to doing that was purely its gap filler until I found something that I really, really wanted to do for myself. I feel like I've always been able to connect very well with founders because being a founder in itself is adversity. And so I'm a very curious person, and I always really want to get to know exactly the way people think and the decisions that they've made. And whenever I ask a question, I'm not asking it like to tick a box. I always try and save my questions for stuff that I'm genuinely interested in. And that's why I guess for Mountside and my company now, we don't have a sales team. We have associates who outbound to companies we really want to work with, but most of my role and the way we bring on clients to work with is I just like sitting with founders, helping them solve their problems, and then when they do think about raising, hopefully I'm the first person that comes to mind.
Yeah, that's amazing. That's a really interesting story. Do you think there's a transition to building just great, profitable businesses now more than there was 4 or 5 years ago, whereas it felt a bit more of a let's raise as much as we can and scale as quick as we can? There seems to be a bit more of a move to profitability earlier, but yeah, keen to get your thoughts on that.
Yeah, for sure. We actually have been working on a lot of venture debt rounds recently, and if a company is looking for a short-term path to profitability and that is foreseeable from the strategy you just mentioned, raising venture debt is arguably a lot cheaper than raising equity. You can be paying 12% interest rather than what a VC targets, which is like 60% IRR. And so we just brought in a new head of venture debt who used to run a debt advisory business to head up that department for us. And we've seen a massive uptick in companies who don't want to raise equity and don't want to go on a burn trajectory, but want a debt facility to bridge them maybe a couple of million to break even and then build their EBITDA margins on that, or get to profitability and then be able to raise from a position where if I don't raise, I can still carry on running a business, which is definitely, we've seen and we've reacted to this to, I guess, change it from something we used to do alongside equity to a standalone department within our company, purely for that reason. Because I think VC capital will become even more concentrated in a very small number of companies, and I think and the ones that need to burn capital, and they're the tip of the iceberg, right? And the iceberg under the water is loads of incredibly good, innovative companies that can be 100 million exit, 200, 500 million exit. But if you look at, let's say, Atomico's latest fund, they need to be achieving like 5 to 10 billion plus exits fairly regularly, rather than the old VC model, which is like the 500 million to a billion exit. And so I think VCs are going to move to trying to find companies that are higher and higher in terms of potential exit value. And I think there will become a lot more innovative funding solutions that can be accessed, and there already have been. We're already seeing pretty much most, even the high street banks, becoming a lot more willing to take on risk that 4 years ago they would never look at, because they've realised that it's a market that they can be competitive in, because they can offer flexible debt solutions that don't require a board seat, don't have a lot of veto and consent rights. It's just and to becoming very flexible with capital repayment holidays as well. So you can take on debt and not have to pay anything back for 12 months, sometimes even 18 months, which gives you that 18 months to deploy that capital, reach profitability, and then start your repayments of the debt once you're in a cash generative position, which many founders we work with see as being a lot more exciting than raising equity, a flat round, or a very small uplift from their prior round, if they haven't hit those kind of growth metrics needed to raise a competitive Series B.
With venture debt, how much is that art and how much is that science? And what are the metrics?
It's all science.
Is it all science?
I'd say it's, I'd say, if in line with my analogy earlier, probably like 10% art, 90% science.
What are they looking? What are people looking to see to get that?
We create banking case financial models, and so if a model for a VC is on the premise that if everything goes well that we think will go well, this is where we get to. The venture debt model is more on a, if not much goes well, we can still repay the debt. And so it's a lot less ambitious, and it's a lot more, we're talking like 20-30% year-on-year growth rather than 100% year-on-year growth.
And in a process, are there any signals when you can feel a buying signal from a VC, and those that it makes sense to cut your losses and save the time?
Yeah. When they WhatsApp us, asking about where they're at in the process, and when you get one saying, I really want to run an IC, but my partner's away on holiday, do I need to get them on a call while they're on holiday, or can I wait till the week after? Then you're kind of like, okay,
this feels good.
Yeah, it feels good. I try and triage all of the 20 questions that the VC asks by like gap filler. They don't actually really need to know this, and this is like a good question for them to ask. And you can kind of tell that if the bucket of good questions that they should be asking fills up to a certain level, that they'll be interested. If an investor is stringing along with rounds of questions of stuff like that really isn't going to move the needle on their investment decision, then you know that they're probably just trying to build the relationship, and they're probably not going to invest right now.
That's super interesting. That is really, really good insight. I hadn't thought about that. That's cool. You work with a lot of CFOs after they've done the Series A or Series B. What in your eyes makes an amazing CFO in a scaling business?
I think what I've seen done really well by a CFO in a scaling business is because we try and step back after the raise, and so pushing us to be like, talk me through all the mechanics of this financial model that you raised on. Talk me through all this ancillary documentation, all this big data analysis you did on orders, rate of sales, distributions, and let me know exactly how you did it and the process for doing it so that I can use this and keep it updated on a monthly basis going forward. I see that surprisingly little.
Really?
Usually it's kind of, let's archive this all, and then if we need to raise again, let's take it out and update it. I'd say that's probably the usual
Wow.
response I see. And so kind of really wanting to understand, especially if it's a lot of CFOs for our Series A businesses come in after the raise, and so they're hired as part of the use of funds. So that drive to really understand why did the investor invest, I think is super key, because ultimately they're joining a venture-backed business, and they need to understand why people have invested into that company, not just what the company does and what are the generic metrics I should be tracking. I think that's the difference between what I think is a CFO versus a FD with the CFO title.
Yeah, I can't agree with you more. It's about insight and impact as opposed to just a really solid finance function. It's the confidence to use data to challenge the business on capital allocation strategy and be proactive on the front foot with supporting the founders to make the right decisions. How are you seeing the market at the moment from a sector alignment perspective? Are family offices, VCs? Obviously, there's a lot of interest in AI, I'm sure, but what's hot in your eyes right now?
I'm going to go against the grain a little bit with this. Whenever people talk about agentic solutions and agents to solve business problems, I see that mainly being B2B SaaS, but the new term for it.
Mm-hmm.
B2B SaaS has always been our staple market, and the VC staple market. And so if you're a B2B SaaS company, you need to be showing typically that you're using off-the-shelf AI to supercharge what you're currently doing. If you can do that, you can still raise a very competitive round. We're working with loads of companies that have raised good Series A's on a couple of million, 1 to 2 million ARR, who have basically weaved AI into their process to increase their gross margins, increasing their time from signing to implementation, who are using it internally to reduce headcount. And so the evolution of B2B SaaS is a big one. There's a very, in Europe in general, there's not really people making bets on foundational models. You've got Minstrel and like 1 or 2 others, but it's not like a really super hot market because the level of capital needed to do that is just it's so high that very few VCs can actually back plans like that. So it's more using others' foundational models and other GPTs to supercharge the processes that you currently have. If you can evidence that you are able to sell to enterprises, have your own platform, but being supercharged with conversational AI especially, then you're probably still going to have a very good time in the market. We've seen a bit of a downturn in fintech investing in general, and that's probably because many of these companies that are tackling problems are doing that not just for the financial industry, they're going a bit broader in terms of market, in terms of for other industries as well. Cybersecurity is a super hot area as well, because cybersecurity fits so much into defense tech. There's basically been like a little shimmy. Everyone's talking about defense tech. Cybersecurity is because obviously a lot of investors want to invest into defense tech, but don't want to invest into weapons and the like. And so it's a good little shimmy that they can say that they're supporting defense tech, but it's a cybersecurity company.
Oh, cool.
Which still is B2B SaaS.
It's been so interesting digging into your mind today. We do need to finish, but before we go, if you could give one tip to a founder in a Series A or Series B business, what would it be?
Don't drip feed a raise. One of the biggest tips I give to founders is saying that you're head down on product and sales and implementation currently. However, you appreciate their interests. Give them some very generic, non-financial information if they ask for something that they can familiarize with themselves with, and add them into a hopper so that when you are looking to raise, you can go out to all of those relationships at the same time and run a process with them. It's very hard to run a process and have back-to-back VC calls and back-to-back DDQs, but if you can do that process, it's so much better. I see so many founders with the bird in the hand versus the two in the bush conundrum, where they've been drip feeding information and they get to a certain level and then the investor's like, okay, great, I want to invest, here's a term sheet, and they panic and then they're like, oh no, I need competitive tensions, but no one else is at the same point in the process. And then if the VC is the only one in the deal, they're dictating timelines and terms and the balance of power.
It's that commitment to a really thorough process, isn't it?
Yeah, but it's hard. It's really hard to run a process without proper support.
Yeah. Jon, thank you so much. I really enjoyed today, and chat to you soon.
Awesome.
Thank you.